All right, so today we're going deep, really deep into the world of risk management.
Oh, yeah, we're talking about a huge topic.
Yeah, I mean, we're talking about how humans went from just leaving the future up to like fate or the
Right?
gods
Just totally at the whim of chance.
to understanding that we could actually like grab the reins and manage risk.
Which, when you think about it, is a pretty wild shift in how we see the world.
Totally. And our guide for this deep dive is a book by Peter L. Bernstein called Against the Gods: The Remarkable Story of Risk.
Oh, yeah. It's a
It
classic.
was published in 1996, and it goes through this whole evolution, you know?
Right, from superstition to like actual frameworks for managing risk.
Yeah. Like, who knew that the invention of numbers and probability theory would, like, revolutionize how we make decisions?
Seriously, I mean, could you imagine a world without the ability to kind of assess the likelihood of events?
Uh, no, not really.
Like to really understand what the consequences of our choices might be.
Yeah, it'd be like walking through a maze but blindfold.
Totally just stumbling around.
Yeah, but let's rewind for a second.
Okay, back in time.
Yeah, way back. Think ancient Egypt.
Oh, wow. Okay.
Like around 3500 BC,
Yeah.
Brunstein, he paints this picture of Egyptians playing games with astragali.
Astragali.
Yeah, those animal knuckle bones, basically the earliest form of dice.
Oh, right, right. So like the OG dice.
Exactly. And it just goes to show that humans have been fascinated by chance and risk for like forever.
I mean, it makes sense. There's something kind of thrilling about it, right?
Totally. And those astragalis, they weren't just toys.
Yeah.
They've been found in tombs,
Mhm.
which suggests they had some kind of like deeper cultural significance.
Yeah, interesting. Like they were trying to roll their way into a good afterlife or something.
Maybe.
Yeah.
And of course, you know, we can't forget about the Greeks.
Ah, the Greeks, always up for a game.
Always. They love their dice games. But here's the thing.
What's that?
Even though they had this sophisticated civilization, the Greeks, they didn't really have a well-developed concept of probability.
Really? That's surprising.
Right. You'd think the civilization that like gave us philosophy and geometry would be all over probability.
Yeah, you'd think so.
But they were more into like oracles and observing the stars for guidance.
Huh. So they were comfortable taking risks,
They were.
but not so much with trying to actually quantify them.
Exactly. But hold on. There was actually one group way back then who tried to get a handle on risk in a more systematic way.
Oh, who was that?
The ancient Jewish scholars who compiled the Talmud.
The Talmud. That's not something you hear about every day in relation to risk management.
I know, right? But the Talmud, it's a collection of Jewish law and tradition.
Right.
And within those texts, you find early attempts to quantify risk, especially in things like property division, damages, even the reliability of witnesses.
So they were basically creating like frameworks for risk assessment way back then.
It seems that way. Talk about thinking ahead.
It shows a real, I guess, desire to kind of manage uncertainty.
Even without the mathematical tools we have today.
Exactly. But to get to those tools, we needed a revolution in how we thought about numbers.
And that's where Fibonacci enters the picture.
Ah, Fibonacci, the rabbit guy.
Yes. He's the one who brought us the Hindu-Arabic numeral system to the West with his book Liber Abaci in 1202.
Okay, and Liber Abaci, that means...
It means book of calculation.
Right, right. Makes sense.
And think about it. We take zero for granted now,
Totally.
but back then it was like a revolutionary concept.
Yeah, I mean, Roman numerals, they were so clunky for calculations.
Oh, for sure. But with the concept of zero and place value, complex calculations became way easier.
It's like going from, I don't know, a horse-drawn cart to a spaceship.
Totally. And it paved the way for modern math, accounting, and ultimately the ability to actually measure and manage risk.
It's like he gave us the language to even talk about risk in a meaningful way.
Totally. But you know what I find really fascinating about Fibonacci? It's not just the numbers themselves, but the patterns they reveal. Like, think about his famous rabbit problem.
Oh, the rabbit problem, yeah.
One where you try to figure out how many pairs of rabbits you'll have after like a certain number of breeding cycles.
Right, right. It gets out of control pretty quickly.
Yeah, it does. But this seemingly simple problem, it leads to the discovery of the golden ratio.
The golden ratio.
Yeah, this magical number, approximately 1.618,
1.618, huh?
and it pops up everywhere. In nature, art, even the human body.
Oh, wow. So it's like there's this underlying pattern, this mathematical relationship.
Yeah. even in things that seem totally random.
And maybe those patterns can help us understand risk in like the bigger world too.
Right. Like there are these hidden connections, these laws of probability that govern how things work.
That's a pretty cool thought.
It is.
Yeah.
Okay, so Fibonacci sets the stage with this new language for numbers.
Okay.
But what about the actual like practice of managing financial risk?
Yeah, how did people actually start doing that?
Well, that's where our next Renaissance man comes in, Piero della Francesca.
Piero della Francesca, the painter.
Yep, the one who painted the Brera Madonna.
Oh, wow. Okay.
But he also he revolutionized accounting.
Really?
Yeah. His work on double-entry bookkeeping was groundbreaking.
So, like, before double entry bookkeeping, how are people keeping track of their money?
It was a lot more haphazard.
Makes sense.
But with double entry, there was suddenly this clear and reliable way to track like income, expenses, assets, liabilities.
Ah, so it brought a new level of like transparency and accountability to finance?
Right. And that ability to assess your financial position is key for managing risk.
Oh, absolutely. Double entry bookkeeping was a major step toward like really understanding and controlling financial risk.
Yeah, businesses could make more informed decisions based on like a clear picture of their situation.
So we're seeing how the ability to understand numbers and patterns, it lays the groundwork for being able to manage risk.
It really does.
Mhm.
But the Renaissance, it was also a time of pushing boundaries in all sorts of ways.
Oh, yeah.
And that includes probability theory.
Ah, and that brings us to Girolamo Cardano.
Cardano, now this guy was a true Renaissance man.
In what way?
I mean, he was a gambler, physician, mathematician, writer, and he had a real penchant for drama.
Wow, he sounds like a character straight out of a movie.
Oh, he totally does. He struggled with gambling addiction. He dealt with family tragedies. His life was a roller coaster.
But through it all, he was making some important discoveries about probability.
He was. His book, Liber de Ludo Alle, which translates to Book on Games of Chance.
Okay.
It explored the math of dice throws. He was like analyzing the probabilities of different outcomes.
So he was moving beyond like just intuition about chance and trying to develop a more systematic understanding.
Exactly. And while his work wasn't always completely rigorous,
Right.
he laid the groundwork for later mathematicians who would refine and expand on his ideas.
And those later mathematicians, they took us even closer to the tools we use today to manage risk.
They did. And speaking of refining ideas, our journey takes us next to 17th century France.
Okay, what happened in France?
That's where Blaise Pascal comes in.
Mm-hmm.
A brilliant mathematician and philosopher.
Pascal.
Yeah, and he took probability theory to a whole new level.
Interesting. So how did he do that?
Well, he and Pierre de Fermat,
Oh, Fermat, the last theorem guy.
that's the one. They tackled this problem known as the problem of points.
The problem of points sounds kind of vague.
Well, it's a gambling puzzle
Okay.
about how to divide the stakes fairly when a game is interrupted before it's finished.
So like if you're playing poker and someone has to suddenly leave,
Yeah, exactly. How do you figure out who's winning?
sounds tricky.
It was. And solving this problem led to some really key insights about probability.
And Pascal, he organized these insights into what we now call Pascal's triangle, right?
You got it.
Okay, now I vaguely remember Pascal's triangle from like high school math.
It's that triangular array of numbers.
Yeah, but how does that connect to managing risk?
Well, it's more than just a cool pattern. It's a really powerful tool for calculating probabilities in all sorts of scenarios.
Really?
Yeah, each number in the triangle, it represents the number of different ways you can get a particular outcome in a series of independent events.
Okay, like flipping a coin multiple times.
Exactly. So it helps us understand the likelihood of different outcomes in situations where chance is involved.
And that's obviously super useful for managing risk.
Totally. Pascal's triangle, it gives us a way to visualize and calculate probabilities, which is essential for making smart decisions when things are uncertain.
So Pascal and Fermat weren't just like solving a gambling puzzle.
No, they were laying the foundation for a whole new way of understanding and managing chance.
It's amazing how these seemingly abstract mathematical concepts end up having such practical applications.
I know, right? This deep dive is blowing my mind already.
And we've only just begun. Next, we'll see how these ideas about probability and chance were actually used to solve real-world problems.
I can't wait. This journey through the history of risk management, it's so much more than just like formulas and calculations.
It really is.
It's about human ingenuity, our desire to make sense of the unknown, and our evolving relationship with chance and uncertainty.
Well said.
I try. All right, so let's take a quick break, and we'll be back to continue our exploration of risk management.
As we delve deeper into this history of risk management,
Yeah.
it's really fascinating to see how closely our understanding of risk is
Mhm.
tied to our understanding of human nature itself.
You know, you're absolutely right. It's not just about the math.
Yeah.
It's about like how we as humans, how we perceive and respond to uncertainty.
Yeah, and no one grasped this better than Daniel Bernoulli. Yeah, a brilliant mathematician who really revolutionized risk management in the 18th century.
Okay, so Bernoulli, he's the one who came up with this concept of expected utility, right?
Right.
But to be honest, I'm a little fuzzy on what that actually means.
Well, before Bernoulli came along, risk was mostly assessed by expected value,
Okay.
which is just a simple average of the possible outcomes of a gamble, for example.
Uh-huh.
But Bernoulli, he argued that people don't just look at those cold, hard numbers.
Right.
They also factor in their own subjective feelings about potential gains and losses.
So it's not just about like how much money you might win or lose.
No.
It's about how those outcomes make you feel.
Precisely. He understood that we humans, we aren't always perfectly rational.
Yeah, I can relate to
That our emotions, they play a huge role in how we perceive and respond to risk.
Yeah, like why someone might choose a guaranteed $50
Yeah.
over a 50-50 chance of winning $100 or nothing.
Exactly. The sure thing, it just feels safer, even if the potential payout is lower.
Right. So Bernoulli's saying that our gut feelings about risk, they actually matter.
Absolutely. And he illustrated this concept with a simple but powerful analogy.
Yeah. Go on.
A pile of bricks.
Pile of bricks.
Yeah.
Okay, I'm intrigued. How does a pile of bricks relate to risk management?
Well, imagine you're building a tower of bricks.
Okay, I'm imagining it.
Each additional brick that you add to that tower, it gives you less and less satisfaction,
But,
right?
I mean, yeah, I guess so.
The difference, it's less noticeable when the tower is already tall.
Ah, okay, so that extra brick, it's more valuable when the pile is small
Yes,
because it makes a bigger difference.
precisely. And it's the same with wealth.
Okay.
Each additional dollar, it's less valuable to someone who's already rich.
No, that's interesting.
And this helps explain why people buy insurance, diversify their investments, and generally try to minimize their exposure to big losses.
Oh, okay, so they're not just looking at the potential gains.
Yeah.
They're also thinking about how much it would hurt to lose what they already have.
Exactly. It's about protecting what you've built, not just chasing bigger and bigger piles.
Right, right. And Bernoulli's insights about human psychology, they had a huge impact on the field of risk management.
They really did.
It seems like we keep learning that managing risk is as much about understanding ourselves
Absolutely.
as it is about understanding the external world.
Couldn't agree more. And that brings us to another fascinating aspect of Bernoulli's work.
Yeah.
The St. Petersburg paradox.
Okay, I love a good paradox. Lay it on me.
All right, so imagine a coin toss game
Okay.
where you keep flipping a coin until it lands on heads.
Okay, got it.
If heads appears on the first flip, you win 2 ducats.
2 ducats.
Okay. If it appears on the second flip, you win 4.
Okay.
On the third flip, 8, and so on.
So the payout keeps doubling.
Yes, exactly.
It's like a pretty good deal.
Yeah.
I mean, the potential winnings could be like enormous.
That's what traditional expected value calculations would suggest.
Right.
However, when you actually do the math, the expected value of this game, it turns out to be infinite.
Wait, infinite? That doesn't seem right. I mean, no one would pay an infinite amount of money to play this game, no matter how high the potential winnings.
Exactly. And that's the paradox.
Okay.
Bernoulli argued that people wouldn't pay an infinite amount because the subjective value, the utility of those increasingly large sums of money, it diminishes.
So even though the potential payout keeps doubling, the emotional impact of winning those huge amounts, it doesn't keep pace.
Precisely. The St. Petersburg paradox, it beautifully demonstrates how human psychology, our subjective experience of value, influences how we perceive and manage risk.
It's like a reminder that our decisions about risk
Hmm.
are often driven by more than just, you know, cold, hard calculations.
Exactly. Now let's fast forward a bit to the 19th century,
Yeah, okay.
to the work of Carl Friedrich Gauss.
Gauss.
Yeah, another mathematical genius who made some really significant contributions to our understanding of risk and probability.
Gauss, the guy who supposedly added all the numbers from 1 to 100 in his head as a child.
The very same.
Wow. Okay.
Among his many accomplishments was his work on the normal distribution, also known as the Bell curve.
Ah, yes, the bell curve.
Yeah.
I remember seeing that bell-shaped curve in statistics class,
Yeah.
and it seemed to describe like
It
everything
it really does.
from heights and weights to exam scores.
And it's a powerful tool for understanding risk. It helps us quantify probabilities and assess the likelihood of different outcomes.
So if we know that a particular phenomenon follows a normal distribution,
Yeah.
we could use the bell curve to estimate the chances of something happening within a certain range.
Exactly. For example, if we know the average return and standard deviation of a particular stock, we can use the bell curve to estimate the probability of it going up or down by a certain percentage.
That seems incredibly useful for investors who are trying to manage their risk.
Indeed. The bell curve is a fundamental tool in finance, insurance, and many other fields where understanding probabilities is essential.
Okay, so the bell curve gives us a way to visualize and quantify risk.
Yeah.
But what about those times when we make predictions based on past performance?
Yeah.
Are we always just doomed to repeat the past?
That's where the work of Francis Galton comes in.
Galton.
Another fascinating figure in the history of statistics.
Okay.
Galton was a pioneer in applying statistical analysis to a whole range of fields, from heredity and psychology to criminology.
Galton, the guy who coined the term eugenics, that's a controversial legacy, to say the least.
But his work in statistics was groundbreaking, and one of his most important discoveries was the concept of regression to the mean.
Regression to the mean. I've heard that term before, but I'm not entirely sure I understand it.
It's the idea that extreme events, they tend to be followed by less extreme events.
Okay.
Things tend to even out over time, to revert back towards an average or mean value.
So if a company has like a record-breaking year in profits,
Yeah.
it's unlikely to repeat that performance the following year.
Exactly. And conversely, if a company has a terrible year, it's likely to bounce back a bit.
Okay, so this concept it has major implications for risk management and decision making.
Oh, absolutely.
We can't just extrapolate from past trends without taking into account this tendency for things to regress to the mean.
Right. So if we see a hot stock soaring in the market,
Yeah.
we shouldn't assume that it's just going to keep going up at that rate forever.
Right.
Regression to the mean suggests that eventually it's likely to revert to a more average rate of return.
This is such an important concept to keep in mind. It's like a reminder that past performance it's not always a reliable predictor of future results.
Exactly. And Galton's work on regression to the mean has had a profound impact on a whole range of fields, from finance and sports to healthcare and education.
Wow.
It helps us understand that while we can learn from the past, we can't simply assume that history will just repeat itself.
This deep dive is really highlighting how much our understanding of risk has evolved over time.
It really has.
It's amazing to see how all these ideas about probability, statistics, and human psychology, they've come together to shape how we think about and manage uncertainty.
And the journey continues. In the next part of our deep dive, we'll explore how these foundational ideas were for further developed and refined in the 20th century,
Okay.
leading to the sophisticated tools and techniques that we use today to navigate the complexities of risk in a rapidly changing world.
Okay, so we've come a long way on this journey, exploring how humans have like wrapped their heads around risk,
We have.
from those ancient dice games to the mind-boggling statistical models we have today.
Yeah.
But where did it all lead? How do
Yeah.
those early ideas actually play out in the modern world?
That's where things get really fascinating. I mean, the 20th century just saw this explosion of new statistical methods and
Yeah.
a growing awareness of, how human psychology like really shapes how we make decisions about risks.
So we're talking about going beyond the theoretical
Yeah.
and into the realm of practical application.
Exactly. And if we're talking practical applications, we can't overlook the work of Francis Galton.
Galton.
I've
Yeah.
got figure we've touched on before.
Right, regression to the mean.
Yeah, remember. The idea that extreme events, they tend to be followed by less extreme ones.
Right, like if a basketball player has a career high game, they're probably not going to do that again the next night.
Exactly. Things, they have a way of balancing out over time.
Okay.
And while Galton had some ideas that were, well, let's just say problematic,
Right.
his contributions to statistics they're undeniable. I mean, he was obsessed with measurement and finding patterns in data, and his work has had like a really profound impact on how we think about risk today.
But how did this concept of regression to the mean,
Yeah.
which he observed in human height, how did that apply to managing risk in, like, say, financial markets?
Well, think about it this way. Let's say a company has, a blowout year,
Well,
record profits.
yeah.
It's tempting to think, oh, that trend's going to continue.
Right.
But regression to the mean, it suggests that's actually pretty unlikely. Their performance is probably going to kind of revert back to a more average level over time.
So chasing the hot stock, the latest investment fad,
Right.
that might not be the smartest strategy.
That's right. Galton's work, it was like a cautionary tale against blindly extrapolating from past data.
Okay.
He taught us to be wary of assuming that what goes up must continue to go up,
Right.
or that past performance is always a guarantee of future success.
It's a reminder that risk management is about being aware of those tendencies to overreact to short-term trends.
Yeah.
And to make decisions based on a more balanced and nuanced view of the data.
Absolutely. And that's where the developments in the 20th century really come into play.
Okay.
Building on the work of pioneers like Pascal, Bernoulli, Gauss, Galton.
Yep.
Mathematicians and economists, they developed these incredibly sophisticated tools and techniques for quantifying and managing risk.
So we're talking about things like modern portfolio theory, statistical modeling,
Right.
and just a deeper understanding of how our own biases can cloud our judgment.
Absolutely. And what's really fascinating is that risk management, it's not about eliminating risk altogether. That's often impossible.
And probably not even desirable.
Right, exactly. Because without some degree of risk, there's no reward, there's no innovation, no progress.
Right. I mean, think about starting a business or launching a new product. There's always a chance of failure.
Yeah.
But without taking that risk, nothing new would ever be created.
Exactly. Risk management, it's about understanding the potential downsides, weighing them against the potential upsides, and making informed decisions that align with your goals.
So it's about finding that sweet spot
Yeah.
between being too cautious and being, too reckless.
Exactly. It's about navigating the world of uncertainty with a clear head, a healthy dose of skepticism, and a toolbox full of techniques for assessing and mitigating risk.
This whole deep dive has been such an eye-opening experience. It's amazing to see just how far we've come in our understanding of risk.
It's pretty
From
amazing.
ancient superstitions to the complex models that are used by financial institutions and businesses today.
And the journeys, it's far from over.
Right.
As our world becomes, increasingly complex and interconnected, our tools and techniques for managing risk, they're going to need to evolve as well. But the fundamental principles, the ones we've explored here, the power of data, the importance of understanding, human behavior, and the need for a balanced and nuanced approach, those are going to continue to guide us.
Well said. So listeners, as you go about your day, making decisions big and small,
Yeah.
remember the lessons we've uncovered. Be mindful of uncertainty, embrace the power of data,
Right.
and remember that the future, while never fully predictable,
Never.
it's something that we can shape through our choices and actions.
And maybe even roll the dice once in a while.
Exactly. Just for fun.
For fun.
Until next time, keep exploring, keep learning, and keep diving deep.